So how do we actually look at which currency to buy or sell? Well, the shortest and simplest answer is something called fundamental analysis. And I'm sure you actually heard about this term before. But when we actually talk about fundamental analysis, we refer to the underlying reasons behind the value of something. So for example, let's say you want to buy a laptop. You don't just want to buy a laptop because the price is low or because everybody else is buying that specific computer. You want to actually see it, test it, and understand the reasons why everybody else is buying it. So before you actually buy it, and before you want to invest your money into buying that computer, you want to know the underlying reasons why that computer is good. So this, of course, seems perfectly natural and normal, like buying materialistic things, like for instance a computer, a car, or a phone. Trading is actually the same. Before buying or selling anything, you must know what's going on fundamentally. And you must understand that why making a trade is a good idea and a good investment. And you do that by focusing on the underlying reasons why price moves, and then you have a better chance of predicting its future movements. And the majority of the educators out there on YouTube or on forums or wherever are focused on teaching ordinary and viral concepts like technical analysis. And the reason for that is that it's very simple to explain, it's very easy to understand. And they can market their product, based on pretty charts or fancy custom indicators. While instead fundamentals are perceived as hard to understand and useless. But in reality, the technicals don't work in the long run, because one day the market will react to that. One day the market will adjust to your strategy. And fundamentals are solid, but the technicals don't work in the long run, or at least are not as solid as the fundamentals. So you need to follow what the professional firms are using in the market. And trust me, they do not base their trades on technical analysis. Every professional trader in the market is looking for a fundamental reason to get a bias for each currency. So if ourselves, we want to compete, then we also need to look at what the professionals are looking at, so that we are not disadvantaged, and so that we don't get caught by the noise and the traps of the markets. So in the end, what types of factors make up some good fundamental analysis? Well, the biggest factor driving the currency is expectations. So not what's happening now, but the expectation of what will happen next. So every day in the market, you need to imagine that you're dealing with a person that is offering you a price on which you can buy or sell. And your job is to analyze the true value of these currencies and understand when the market is offering you an opportunity to enter that position to make a profit. Is the market offering me a deal? Is that currency undervalued or overvalued? Can I jump in to make a profit? The key rule on trading is to never focus on what is happening now on your screen with the price, or even, and listen, be careful, or even on what you think should happen based on some rule of logic or common sense. You always want to be as analytical as possible. You don't want to follow your gut, okay? You can follow your gut when you have 20 years of experience. So now let's take a look at what actually those expectations are based on. I can go full in depth here, but I can give you the best summary. And that market expectations revolve around what the specific central bank of the country is doing. So specific central bank of the country is the Federal Reserve for the United States, the RBA for Australia, the RBNZ for New Zealand, the Bank of Canada for Canada, and so on. So everything revolves around the central banks, on not only what they are doing right now, but what they will do next. So what's their plan on monetary policy? And monetary policy is a key term you must understand, and is the main tool that a central bank uses to control the health of this country and to control the value of the currency. So key factors to pay attention in the markets are central banks, and not only their current actions, but the expectation of what they will do next. You must put this in your mind, because every professional trader must know what central banks are doing, and every professional trader must have a clear picture of what they want to do next. And if a clear picture is not available, because the central bank message is messy and confused, then you should avoid that specific currency. So as I already said, the purpose of a central bank is to make actually sure that the country is nice and healthy. So if unemployment rises, for instance, or the price of goods are rising too fast, then the central bank will step in, or should step in, and act to support the weak economy with some stimulus. So they monitor the economy by analyzing the economic data that is released every week, and that you yourself can see every day from your forex calendar. So you have access to the data that the central banks are looking at to decide their policy. Inflation in particular is closely monitored by the central banks. And other than that, there are a lot of other factors affecting monetary policy, like the labor market, or for instance, the commodity market for commodity-related currencies, like the Canadian dollar, the New Zealand dollar, and the Australian dollar. Now listen to me careful, because the key here is for the trader to watch and figure out these economic releases and keep track of how they are evolving to be one step ahead of the central banks. You got me here? You want to anticipate what their statements will be. This way we can position ourselves ahead of everyone else by forecasting how the economy will perform in the future, and that's how the central banks will react to it. So by looking at what they're looking at, we get into their mind and we understand what their next policy will be. And this type of analysis will start to highlight specific currencies to trade in itself. So for instance, if you see that the Bank of Canada is all over the news and everybody is looking at what they might do next, then the logic should tell you that you should focus on the Canadian dollar. You should research the Canadian dollar as a possible currency to commit some capital. And remember that a trader is always a slave to volatility. So we must seek for currencies that will move based on solid reasons. If you focus on a currency that is not moving, then you're placing yourself a further obstacle to your profits. And this brings us to another point. All currencies are traded in pairs, right? Euro USD, Euro CAD, USD GPI. So you need to pair your currency in focus to another currency. And the logic here, what should tell you? The logic here should tell you that you want to pair a fundamentally strong currency to a fundamentally weak currency, right? Now, to start gauging on how to conduct this type of fundamental analysis, we ourselves have made this process as simple as possible. And all you need to do is follow along our easy to understand fundamental analysis that we share on the private network, for instance. We definitely think it's more effective to provide the info and to simply show you the info in action by sharing our trades. And when you trade on your own, you want to begin tuning into the info that we share. You may find it a little bit overwhelming at the beginning. With some time, practice, and assistance, you will start to see profitable opportunities presenting themselves every single week. So, to wrap this out, the way we find the best currencies to trade is by conducting fundamental analysis. And fundamentals is actually the real reason why price is moving, because that reason is the expectations on future monetary policy and future economic data, because the monetary policy is dependent on economic data. So always keep in mind that central banks use the economic data releases. So they look at the economic data that is released every week to keep track of the health of the economy and to see if they need to step in or not. So why don't you keep track of that data yourself to start to gauge if you can understand the policy that the bank is using?